We've seen this return of the QE trade really fueled, as we've been talking about, the ECB yesterday, policymakers saying that a cut would be one of their first moves for added stimulus. So where we're seeing investors going to for this QE trade? Well, one of the big trades which we are seeing are the QE favorites, bonds from Italy, Spain, France. We saw French 10-year yields hit 0% for the first time. But the shape of these bond trades really look like curve flatteners. We're seeing long duration outperform because it's these longer term securities which the ECB still has room to buy. But moving to the U.S., we're seeing the return of TINA. This time, though, it's the American credit edition. We're seeing, especially investors overseas, it's almost a necessity to move into U.S. credit, to look for that income, to look for that yield, according to Bank of America. Finally, we're getting also bets that the dollar is going to be able to power through any sort of Fed cuts we might see. That's helping gold and just generally defensive sectors doing a lot better, and any sort of bond proxy. But okay, let's say the Fed today does clear the way for some rate cuts, maybe not today, but in the future. Is all this defensiveness, the crisis era playbook, necessary? Well, history might suggest so. That's because when we've seen cuts in the past from the Fed, which I've circled here in the yellow, just as the economy looks to be getting late cycle, we soon after do see a recession. And Nara, just to put this in context, yesterday we saw the latest Bank of America survey where a record majority, about 87% of investors, said that yes, we are indeed in the late cycle of the economy right now.